Today we're going to talk about two different alternative financing methods: accounts receivable financing and supply chain financing. The two methods are similar, but accounts receivable financing focuses on business-to-customer relationships, while supply chain financing focuses on business-to-business relationships. So we'll start with accounts receivable financing, which is also called factoring financing. So what is it? Factoring financing is a type of financing arrangement in which a company can immediately receive financing capital related to a portion of its accounts receivable. For decades, liquidity issues have always been one of the many problems businesses face because the speed of converting a specific asset or liability into money can greatly affect the operation performance. Imagine being a business owner who has to wait for months to convert their account receivables into cash so that the business can keep running. Those long months of waiting are costly because no money can be substituted for time. This is why factoring, or account receivable financing, can be extremely helpful. So how does it work? Imagine a shoe company is selling $4,000 worth of shoes to a customer on account. Depending on the terms of the invoice, the shoe company might have to wait 30, 60, or even 90 days to receive the $4,000. During this time, the shoe company has the account receivable worth of $4,000, but it cannot really do anything until the due date. In extreme cases, the shoe company can lose new orders since it cannot produce more shoes without money to cover the production cost. When dealing with this situation, the shoe company can go to the bank and file for a financing option. However, receiving financing from banks can be a timely process, and your credit rating must be taken into consideration. On the other hand, account receivable financing is much simpler, and the credit rating terms are much more flexible. When choosing to factor, within 3 or 4 days, depending on the factoring company, the shoe company can sell their account receivable in exchange for cash, typically 80% of the account receivable value. After the due date of the invoice, the factoring company will pay the shoe company the rest minus the charging fee. So why might a company engage in factoring financing? One benefit is that when using factoring financing, the company can increase its liquidity by receiving cash almost immediately. Liquidity is crucial because the value of money in the present will always be greater than the value of money in the future. Additionally, factoring financing will allow you to shred the worry about account receivable collections. Moreover, with better liquidity, you gain business opportunities. Many businesses have lost golden opportunities because they didn't have enough liquidity to take care of their operation expenses. Lastly, since you are transferring your invoices to the funders, your business transactions with customers will mostly be carried, and thus it enhances the credibility between you and your customers. However, factoring financing also has its disadvantages. For example, the charging fees from the factoring companies can be costly if the company's credit rating is low. More importantly, depending on the circumstances, the value received from factoring financing can be substantially smaller than what a company should get from its accounts receivable if the charging fees are too high. Some recommended sources for factoring are Bluevine, Payability, Paragon Financial Group, Harper Partners, and Crestmark. So now we'll move on to supply chain financing. So what is supply chain financing? Supply chain financing works similar to factoring. However, it deals with the account payables of the company, and it focuses on the relationship between a company and its vendors. So how does it work? When the company and its vendors engage in supply chain financing, the vendors can have the option of collecting all approved invoices immediately with smaller fees compared to factoring. For example, imagine a 30-day maturity invoice of $4,000 is given to company ABC by its vendor. If the vendor needs immediate cash within the 30 days, it will have to renegotiate with ABC to speed up the process. This can be a problem for both parties because ABC might not have the money to pay the vendor. However, instead of trying to reach a negotiation that might harm this business relationship, ABC can ask its vendor to participate in a supply chain financing program with a funder. When doing this, the vendor can ask for quick payments of any portion of the invoice, and it will be provided instantly by the funder. Additionally, ABC does not have to worry about paying money to its vendor anymore because it will only need to pay the invoice to the funder on the maturity date. Additionally, ABC does not have to worry about paying money to its vendor anymore because it will only need to pay the invoice to the funder on the maturity date. So why choose supply chain financing? For company ABC, participation in a supply chain finance program can provide one of these following benefits. 1. Supply chain financing boosts your working capital. The vendor may now collect any invoice once it was approved, regardless of its maturity date. This bolsters your negotiation power, giving you a powerful avenue to request longer payment terms, either immediately or at the next time you negotiate commercial terms. Second, supply chain financing boosts your EBITDA. ABC can receive additional rebate income from the funder whenever the vendor gets paid early. Third, supply chain financing boosts your relationship with vendors. When participating in a supply chain finance program, the vendor will always be paid 100% of the amount of the invoice at maturity. This will enhance your credibility. Lastly, supply chain financing reduces your supply chain risks. Supply chain financing reduces ABC's dependency on costly financing options like traditional loans. Supply chain financing programs are completely controlled by company ABC with flexible terms. Some recommended sources for supply chain financing are Citibank, Orbion, BNP Paribas, MUFG, and HSBC. So who should consider supply chain financing or factoring? A company should consider supply chain financing or account receivable financing when it is in one of these circumstances. 1. The company needs quick turnaround, or they're experiencing rapid expansion. There will be a time when the company cannot wait for its customers to pay their invoices, especially when funds are tight and expenses are stacking up. Secondly, a company could choose supply chain financing or accounts receivable financing when traditional lending might not work. Companies might find it difficult to receive loans from banks when their past financials do not look well, or the process is too long and complicated. Third, when a business depends on the season. Traditional bank loans might not be a good fit for businesses that depend greatly on specific seasons. Accounts receivable financing can be more flexible when it comes to providing loans at a specific time. And last, if a company's credit is imperfect. A traditional loan can be complicated if the company's credit profile is not great. However, in factor financing, this isn't the case. Factors focus on the credit history and ability of the client's customers. It allows a lender to focus on the assets being financed, or the invoices, even if the owner's credit is flawed. The sources for all the facts in this video can be found at these links. We hope this was helpful, and please return to Fordham Business Development Collaboratory's YouTube channel for more videos.